The market is making a strange promise right now. It is telling you that artificial intelligence will change the world. And it probably will. It is telling you that the strongest companies on earth will keep growing. And some of them probably will. But at the same time, beneath the surface, the market is also whispering something much darker. It is saying that too much wealth has been built on too little cash. That the most powerful insiders in Silicon Valley may be preparing to sell. That good earnings are no longer, and that the next stock market crash may not begin with bad news. It may begin with the most exciting IPOs in history. This is not a crash. This is a setup. There are moments in markets when the surface becomes almost useless. Prices go up. Headlines stay optimistic. Analysts raise target. Everyone says the same thing. This time is different. But the structure underneath starts to change. And that is where a contrarian investor pays attention. Right now, the market is not being held up by broad strength. It is being held up by a narrow story. Artificial intelligence, mega-cap technology, data centers, chips, cloud infrastructure. Private AI companies with valuations that would have looked impossible only a few years ago. This story has become so powerful that investors are no longer asking what these businesses are worth today. They are asking what they could become in 10 years, then discounting that dream back into today's price. That is not always irrational. Great technologies deserve premium valuations. Railroads changed the world. Electricity changed the world. The internet changed the world. Smartphones changed the world. Artificial intelligence may belong in that same category. But there is a difference between a real technology and a safe price. That difference is where fortunes are lost. At the same time, the macro backdrop is no longer friendly. Inflation is not dead. Oil is no longer quiet. Bond yields still matter. The Federal Reserve does not have unlimited room to rescue markets if prices start rising again. Gold and silver are acting less like forgotten relics and more like insurance policies. Bonds are not giving the clean safety signal investors want. And the dollar sits in the middle of it all, absorbing fear policy and liquidity stress. So the contradiction is simple. The market is priced like money will remain easy. But the economy, behaving like money, may need to stay tight. That is the problem. If liquidity remains abundant, the bubble can stretch longer. If liquidity tightens, the same market that looks unstoppable can suddenly become fragile. And the most dangerous part is this. The trigger may not look like a trigger. It may look like opportunity. A massive IPO, a famous company, a historic listing, a chance for everyday investors to finally buy the real thing. But Wall Street does not create exits for you. Wall Street creates exits for someone else. Most investors believe the story is simple. AI is the next industrial revolution. The largest technology companies are spending hundreds of billions to build the infrastructure. Chips of the new oil. Data centers are the new factories. Private AI labs are the new railroads. And anyone who hesitates will miss the future. That narrative is emotionally powerful because it is partly true. Artificial intelligence is real. Demand for compute is real. Data center construction is real. Enterprise adoption is real. The productivity potential is real. This is what makes the setup dangerous. The most expensive bubbles are not built on lies. They are built on truths taken too far. The mainstream view says, if AI is real, then AI stocks must keep rising. It says, if SpaceX, Anthropic, OpenAI, NVIDIA, Microsoft, Amazon, Meta, and Google are at the center of the future, then valuation is secondary. It says, if the company is great, the stock is safe. But that is not how markets work. A great company can be a terrible investment at the wrong price. A revolutionary technology can still destroy investors who arrive late. And a bubble can burst, even when the underlying innovation survives. That is what most people miss about 2000. The internet did not fail. The prices failed. Amazon survived. Google was born from that era. Broadband expanded. E-commerce became normal. The world changed exactly the way the optimists said it would. But investors who paid any price for any internet story were wiped out. The narrative was right. The entry point was fatal. Today, The mainstream crowd believes the same thing cannot happen because today's AI leaders are stronger. They have revenue. They have cash flow. They have dominant platforms. They are not the empty dot-com shells of the late 1990s. And again, that is partly true. This is not 2000 in a simple copy and paste way. But markets do not need identical conditions to rhyme. The question is not whether AI is real. The question is whether the amount of money chasing AI can support the valuations already created. That is where the story starts to crack. The mistake most people make is that they confuse wealth with liquidity. They see trillions of dollars in market capitalization and assume there must be trillions of dollars available to support those prices. But market cap is not cash. Market cap is the last price multiplied by every share. It is a number based on the assumption that the next buyer will pay the current price. But what happens when many holders want to convert that paper wealth into real money? That is when the illusion gets tested. A bubble does not die when the story fails. A bubble dies when the cash runs out. And imagine a neighborhood where one house sells for $1 million. Suddenly, every similar house is worth $1 million on paper. The neighborhood feels rich. Everyone checks their home value and smiles. But if 10 owners try to sell at the same time, the question changes. It is no longer, what is my house worth? It becomes, who has the money? That is the exact problem facing high valuation AI and technology assets. For years, investors could not buy many of the purest AI companies directly. So they bought proxies. They bought chip companies. They bought cloud companies. They bought mega cap platforms. They bought anything connected to AI infrastructure. But when the private giants start coming public, the market gets a new choice. Why own the proxy when you can buy the object of the obsession itself? That sounds bullish at first, but it creates a hidden liquidity problem. If investors want to buy the new listings, they need money. That money has to come from somewhere. Portfolio managers do not magically create unlimited cash. Index funds have rules. Institutions have allocation limits. Hedge funds manage exposure. Retail investors often sell one thing to chase another. So when a giant IPO arrives, it can become a vacuum. It pulls capital toward the new shiny asset, and it forces selling somewhere else. That is why the timing matters. If major AI and space-related IPO arrive after years of gains in the existing AI trade, the buyer base may not be fresh. It may be recycled. Money does not just enter, it rotates. And when money rotates out of the leaders, the index can weaken even while the headline story remains exciting. This is why Broadcom's sell-off mattered. The point is not that Broadcom is a bad company. It is not. The point is that when a stock has already priced in perfection, good news becomes insufficient. Investors stop rewarding strength. They start asking, is this as good as it gets? That is late cycle behavior. In early bull markets, bad news gets ignored. In late bull markets, good news gets sold. There is another layer. The Federal Reserve. For most of the post-2008 era, investors learn one lesson. When markets break, the Fed appears, rate cuts, liquidity facilities, balance sheet expansion, emergency support. Investors were trained to believe every sell-off would eventually be rescued. That assumption depends on inflation. If inflation is low, the Fed has flexibility. If inflation is high, the Fed has a problem. A central bank can fight a market crash, or it can fight inflation. It becomes much harder to fight both at the same time. That is why oil matters. Oil is not just a commodity. Oil is a tax on the entire system. It affects transportation, plastics, chemicals, airlines, shipping, food, and consumer psychology. When oil rises sharply, inflation can become sticky. When inflation becomes sticky, rate cuts become harder. When rate cuts become harder, valuations become more fragile. This is where the mainstream view becomes too simple. They think the only question is whether AI earnings keep growing. But the real question is whether the liquidity structure can support AI valuations while inflation, oil bonds, and IPO supply all apply pressure at the same time. Price tells you what people believe. Structure tells you what they can afford. To understand this market, you have to separate three things: the technology cycle, the liquidity cycle, the investor psychology cycle. The technology cycle can be strong for years. AI adoption can continue. Data centers can still be built. Productivity tools can keep improving. The best companies can keep growing. But the liquidity cycle can turn before the technology cycle peaks. That is what happened in 2000. The internet was not a fake invention. The problem was that capital markets funded too many dreams at prices that required perfection. When liquidity tightened and investor patience disappeared, the weakest companies collapsed first. Then the pressure spread. Eventually, even quality companies were dragged down. The Nasdaq did not fall because the internet disappeared. It fell because expectations became impossible to satisfy. In 2008, the mechanism was different, but the lesson was similar. Housing was not fake. People need homes. Mortgages are real financial products. Banks are real institutions. But leverage turned a normal asset class into a systemic risk. When the structure broke, price followed. In 1973 and 1974, inflation and oil shocks collided with expensive equities. The result was not a clean, quick correction. It was a grinding repricing of an entire market regime. Investors who had believed the Nifty 50 were one-decision stocks learned that even elite companies can be punished when inflation changes the discount rate. That period matters today because investors once again treat a small group of dominant companies as almost untouchable. The names are different. The psychology is not. Back then, investors believed the best companies could be bought at any price and held forever. Today, many investors believe the same thing about AI winners and mega-cap technology. But great business is not the same phrase as great investment. The hidden variable is always price, and price is driven by liquidity. This is why giant IPOs can mark important moments in a cycle. An EPO is not just a company going public. It is a transfer. Early investors, employees, founders, and private funds get a path toward liquidity. Public investors get access. Investment banks get fees. Indexes eventually adjust. Institutions rebalance. Everyone celebrates the opening bell. But a contrarian asks a colder question. Why now? Why are the people with the most information choosing this moment to sell part of their ownership to the public? Sometimes the answer is innocent. A company needs capital. A business is mature. Public markets are the next logical step. But near the end of a speculative cycle, EPO waves often carry a different message. Insiders are not stupid. They know when demand is hot. They know when investors are willing to pay for distant dreams. They know when a story is strong enough to overcome valuation discipline. And they know that the public market can provide something private markets cannot: mass liquidity. This does not mean every IPO is bad. It means the wave matters. One major listing is an event. Several massive listings arriving after years of speculative gains is a signal. The market is being asked to absorb new supply at the exact moment valuations already require faith. That is the tension. Now add index mechanics. When a company becomes large enough to enter major indexes, passive funds may eventually need exposure. But passive buying is not free money. Indexes are baskets. To add something, weight must come from somewhere. Other holdings get trimmed. Active managers anticipate this. Hedge funds position around it. Retail investors chase the obvious headline after the smart money has already modeled the flows. This is how a bullish event becomes a liquidity drain. Then comes the second-order effect. If investors sell AI proxies to buy direct AI listings, the old leaders lose scarcity value. For the last several years, if you wanted exposure to the AI boom, your choices were limited. You bought chips, cloud, software platforms, and the mega-cap companies funding the ecosystem. Scarcity made those assets more valuable. But when the market gets more pure-play options, scarcity fades. That does not mean Nvidia, Microsoft, Amazon, Alphabet, Meta, or Broadcom collapse as businesses. It means the premium attached to being one of the only investable AI vehicles can compress. That is a different kind of risk. Multiple compression. And multiple compression is brutal because it can happen even while revenue grows. A company can increase earnings and still see the stock fall if the valuation investors are willing to pay decline. This is the part most retail investors hate because it feels unfair. They say, but the company did well. The market replies, not well enough. That is what a late cycle tape looks like. Expectations become a ceiling, liquidity becomes the floor, and both start moving against you. Now consider the Fed's position. Reserve management purposes may support reserves in the banking system, but they're not the same psychological force as emergency quantitative easing during a panic. Investors may call every balance sheet expansion, money printing, but central bank operations have different purposes, different signals, and different market effects. A contrarian should not simplify this into a cartoon. The Fed can provide plumbing liquidity while still keeping policy restrictive if inflation is too high. That is the dangerous combination. Enough liquidity to extend speculation, but enough policy flexibility to rescue it cleanly when it breaks. This is how markets form traps. They do not collapse when everything looks terrible. They usually peak when the story is still beautiful, the charts still look strong, and the final buyers believe they are buying the future. So what is the real signal? It is not one exact date. Markets do not send calendar invitations before they break. The real signal is the transition from price momentum to structural weakness. That transition happens in stages. First, leadership narrows. Fewer stocks carry more of the index. The market looks strong, but the strength becomes concentrated. Second, valuation stops mattering until suddenly it matters all at once. Investors ignore price to sales, margins, dilution, and capital intensity because the story is too powerful. Third, insiders and private companies rush toward liquidity. EPO windows open. Secondary offerings appear. Employees and early investors prepare to monetize paper gains. Fourth, good news starts failing. Earnings beats are sold. Strong guidance is questioned. Stocks that should rally begin to drop. Fifth, macro pressure removes the safety net. Inflation stays sticky. Oil rises. Bond yields refuse to fall. The Fed becomes less able to cut quickly. Sixth, the lockup clock starts ticking. After major EPOs, early holders may be restricted for a period, but markets look ahead. They know future supply is coming. They know more shares may hit the market. They know the dream eventually has to meet the income statement. This is why the danger window matters more than the exact day. The public thinks in dates. Professionals think in windows. A crash is rarely one event. It is a process that becomes visible all at once. By the time the index is down hard, the internal damage has usually been building for months. The smarter question is not when is the crash. The smarter question is what has to happen before forced selling begins. For this market, the answer is likely a combination of things. Mega IPOs absorbing capital. I-proxies losing scarcity value. Earnings reactions weakening. Oil and inflation limiting Fed support. Bond yields pressuring long-duration growth stocks. And eventually lockup expirations creating a path from paper wealth to real cash. That is the signal, not panic, conversion. The moment wealth tries to become money. Contrarian investors understand that price and structure are not the same thing. Price is the advertisement. Structure is the truth. A stock can be rising while structure deteriorates. A market can hit new highs while liquidity thins. A bubble can look strongest right before it becomes unstable. This is why discipline matters more than prediction. You do not need to know the exact top. You need to know when the odds have changed. You need to know when the market is no longer paying you after the risk you are taking. And you need to recognize when excitement has become distribution. That is a quiet word behind every late-stage bubble. Distribution. The public sees opportunity. Insiders see liquidity. The public sees access. Early investors see an exit. The public sees a historic moment. The contrarian sees supply. The next stock market crash will probably not begin with a headline that says, "The bubble is over." It will begin with explanation. A stock fell because expectations were too high. A sector corrected because investors took profits. An IPO struggled because pricing was aggressive. Bond yields rose because inflation was sticky. Oil moved because of geopolitical risk. The Fed stayed cautious because the data was too strong. Each explanation will sound reasonable on its own, but together, they may describe a larger shift. The market is moving from abundance to selectivity, from scarcity value to supply, from story to proof, from paper wealth to cash demand. That is the real date to watch. Not a number on a calendar, a change in behavior. When good news stops work. When IPOs absorb capital instead of creating confidence. When AI leaders trade less like monopolies and more like expensive cycles. When the Fed cannot give investors what they want because inflation will not allow it. When the safest assumption becomes the most dangerous one. The easy conclusion would be to say the market must crash tomorrow. That is not the Burry mindset. The better conclusion is colder. The market can keep rising longer than skeptics expect, but every point higher may increase the amount of future selling required to justify the wealth already created. That is how bubbles mature. Not through stupidity, through belief, through leverage, through extrapolation, through the quiet assumption that someone else will always be there to buy, but eventually the buyer asks for proof, and when proof is not enough, price adjusts. This does not mean investors should fear every correction. Corrections are not the enemy. Being unprepared is the enemy. A crash destroys people who confuse narrative with risk management, but it creates opportunity for people who kept cash, kept discipline, avoided the final mania, and knew what they wanted to own when forced sellers appeared. The future is not dead. AI is not dead. Innovation is not dead, but the price of a dream can still be too high. And when everyone wants the future at the same time, the future becomes expensive. So watch carefully. Watch how the market reacts to good news. Watch where capital rotates after the giant IPO. Watch oil. Watch bonds. Watch inflation. Watch whether the Fed still has room to protect asset prices. And most of all, watch the difference between excitement and liquidity. Because the next crash may not announce itself as fear. It may arrive disguised as access. A chance to finally buy the companies everyone has been waiting for. A chance to participate in the future. A chance to become the exit liquidity for someone who arrived years before you. Think independently. Respect the cycle. Never confuse a real revolution with a fair valuation. And remember this, the crowd asks, what can I buy? The contrarian asks, who is selling it to me and why now? That question will not make you popular. And market's popularity is usually expensive. This is Burry Mindset. Subscribe if you want calm analysis in the market addicted to noise. And until next time, do not just watch the price. Watch the structure.